Standing by. Welcome to the fourth quarter earnings call. At this time, all participants are in a listen-only mode. Please be advised that today's conference is being recorded. After the speaker's presentation, there will be a question-and-answer session. To ask a question during that time, you will need to press star 1 on your telephone. If you require any further assistance, please press star 0. I would now like to hand the conference over to your first speaker for today, Mr. Richard Delancey, Cfo. Thank you. Please go ahead.
Thank you, Ann, and good afternoon to everyone. I'll start by stating that these discussions will include forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These statements involve risks and uncertainties that may cause actual events, results, and/or performance to differ materially from those indicated by such statements. The risks and uncertainties include, but are not limited to, those outlined in today's call, as well as other risks identified from time to time in the company's public statements and reports filed with the SEC. Forward-looking statements speak only as of the date they are made, and the company does not undertake to update these statements except as required by law. In today's press release, we reported operating results for the fourth quarter of fiscal 2021, the 16 weeks ended August 29th. Reported net income for the quarter came in at $1.67 billion, or $3.76 per share. Last year's fourth quarter net income came in at $1.389 billion, or $3.13 per diluted share. This year's fourth quarter included an $84 million pre-tax, or 14 cents a share charge for the write-off of certain IT assets. Last year's fourth quarter included $281 million pre-tax charge, or 47 cents a share, of COVID-related costs. As well, it included a $36 million, or 6 cents a share, pre-tax charge related to the prepayment of $1.5 billion of debt, partially offset by an $84 million, or 15 cents per share benefit for the partial reversal of a reserve related to a product tax assessment taken in the fiscal year 2019. Net sales for the quarter increased 17.5% to $61.44 billion, up from $52.28 billion a year earlier in the fourth quarter. Comparable sales for the fourth quarter, as reported an hour ago, for the 16 weeks on a reported basis, the U.S. was 14.9%. Excluding gas, inflation, and FX, the 14.9 would be 10.3% positive. Canada reported 19.5% plus. Ex-gas, inflation, and FX, 6.7%. Other international reported 15%. Without gas, inflation, and FX, 7.3%. Total company, 15.5% reported, 9.4% ex-gas, inflation, and FX. E-commerce, by the way, reported was 11.2% positive, ex-gas, inflation, and FX, or ex-FX, 8.9%. In terms of Q4 comp sales metrics, traffic or shopping frequency increased 9.2% worldwide and 8.8% in the U.S. Our average transaction or basket was up 5.8% worldwide and 5.6% in the U.S. during the fourth quarter. Those numbers including the positive impact from gas, inflation, and FX. Foreign currencies relative to the U.S. dollar positively impact sales by approximately 230 basis points, whereas gasoline price inflation positively impacted sales by approximately 385 basis points. Moving down the income statement to the membership line, membership fee income for the fourth quarter came in at $1.234 billion in the fourth quarter of 2021. That's up $128 million from the prior year's fourth quarter membership fee income of $1.106 billion. The $128 million represents an 11.7% increase year over year. Excluding the benefit from positive FX, the $128 million positive number would have been $107 million positive, or a 9.7% effective increase. In terms of renewal rates, at the fourth quarter end, our U.S. and Canada renewal rate was 91.3%, up 0.3 of a percentage point from 16-week earlier number at Q3 end. And worldwide renewal rate came in at 88.7%, also up 0.3 of a percentage point from Q3 end 16 weeks earlier. The renewal rates are benefiting, we believe, from more members auto-renewing, as well as increased penetration of executive members, who on average renew at a higher rate than non-executive members. Our first-year renewal rates have also improved as well during this time. In terms of number of members at Q4 end, member households and total cardholders, at Q4, the fiscal year end a few weeks ago, Total paid households were 61.7 million. That's up 1.1 million from the $60.6 million figure we shared with you 16 weeks earlier. Total cardholders came in at 111.6 million, or 1.8 million higher than the 109.8 we had as of Q3 end. At Q4 end, paid executive members came in at 25.6 million, an increase of a little over a million new executive members, and that's during the 16-week period as well. Moving down to the gross margin line, our reported gross margin in the fourth quarter was lower year over year by 32 basis points, and actually excluding gas deflation, it was higher by 5 basis points. As I usually do, I ask you to jot down 2 columns of numbers, a little gross margin matrix, if you will. The line items will be core merchandise. Ancillary, second line item would be ancillary and other businesses. Third line item would be 2% reward. Fourth line item would be Lifo. And last line item would be other. And then finally, the last line item would be total. 2 columns, the first one being reported year over year in the fourth quarter, and the second column excluding gas inflation. So core merchandise on a reported basis was lower year over year by 90 basis points. Ex-gas inflation, it was lower, minus 57 basis points. Ancillary and other businesses, plus 44 on a reported basis, and plus 53 ex-gas inflation. 2% reward, plus 1 basis point, and minus 3 year over year on a ex-gas inflation. Lifo, minus 5 and minus 5 basis points, and other plus 18 and plus 17. If you add up the 2 columns, you get the total for reported, the 32 basis points that I just mentioned, and again, ex-gas inflation plus 5 basis points. Now, the core merchandise component you see here are lower by 90 year over year and lower by 57 ex-gas inflation. Similar to last quarter, this is primarily a function of sales shifting from core to ancillary versus the last year as we begin to revert back to more historical sales penetrations. Recall last year we saw a significant shift of sales out of ancillary and other businesses and into the core. In terms of the core margin on their own sales, in the fourth quarter, the core-on-core margins were lower by 40 basis points, with non-foods slightly up, food and sundries slightly lower year over year. Fresh foods was down and was the fundamental driver of the core-on-core being lower in the quarter. Now, fresh foods is lapping exceptional labor productivity and low product spoilage that occurred from the outsized sales a year ago in Q4. We retained some of those productivity gains as volumes have remained high. However, we've also elected to hold, delay, and or mitigate some of the price increases in this increasingly inflationary environment over the last few months. Ancillary and other business gross margin, as you see in the chart in the matrix, was higher by 44 basis points and higher by 53 ex-gas inflation in the quarter. Gasoline had a good quarter as we are lapping year over year a softer quarter due to the pandemic. We also showed improvement in food court, optical, travel, all of which were benefited by easy compares versus last year, also due to the impacts of COVID on those businesses. Now, Lifo, this is a gross margin charge that we haven't seen in this matrix for about 7 years. Lifo was lower by 5 basis points, both with and without gas inflation. We had a $30 million Lifo charge in the quarter, the first such charge since 2014. This is a result of the continued inflationary cost pressures, which I'll discuss more in a few minutes. 2% reward, higher by 1 basis point on a reported basis, but more importantly, lower by 3 basis points ex-gas inflation, again implying a slightly higher penetration of sales going to the executive member and the associated rewards that come with it. And other is up 18 basis points and then up 17 ex-gas inflation. This is primarily related to COVID-related costs from a year ago. Moving to SG&A, our reported SG&A in the fourth quarter was lower or better year over year by 45 basis points and lower or better by 13 basis points excluding gas inflation. Second matrix of the day, the 2 columns reported and ex-gas inflation, and 5 line items, operations, second line item central, third line item stock compensation, fourth line item other, and then total. On a reported basis, core operations was lower or better by plus 19 basis points, and ex-gas inflation higher by 8 basis points, so minus 8 basis point. Central, plus 12 and plus 8. Stock compensation, plus 2 and plus 2. And other, plus 12 and plus 11. Adding up the columns, again, SG&A on a reported basis was better or lower by 45 basis points and lower ex-gas inflation by 13. As you can see in the matrix, the core operations component again was better by 19 lower by 19 and then higher by 8, excluding the impact from gas inflation. Keep in mind, this results includes the permanent $1 an hour wage increase that we implemented in March of this year. This higher by 8 basis point year-over-year expense result it includes the 14 basis point cost of the $1 an hour wage increase. Central, again, improved by 8 basis point ex-gas inflation. And stock compensation also with strong sales, it helped by 2 basis points. Now, the other of plus 12 or plus 11 without gas inflation, so lower by those amount of basis points. Included in other last year was the COVID expense of $217 million or 42 basis points, and a reversal of a product tax assessment reserve of $84 million or 16 basis points. This year includes the write-off of the IT assets totaling $84 million or 14 basis points. So you add all those up, that's where you get the 11. Next on the income statement is pre-opening. Pre-opening this year was $35 million. Last year, $26 million, so higher by 9. Pre-opening is up year over year in part due to the timing of openings and given different amount of pre-opening on a given location, both within the quarter and in the following quarter. All told, reported operating income in the fourth quarter increased by 18%, coming in at $2.275 billion this year compared to $1.929 billion a year earlier. Below the operating income line, interest expense was $52 million this year, essentially the same as $51 million a year ago. Interest income and other for the quarter was higher by $77 million year over year. Roughly half of that is due to favorable FX, and the other half is related to last year's fourth quarter charge for the make-whole debt prepayment. Overall reported pre-tax earnings in the fourth quarter of 2021 came in up 23%, coming in at $2.291 billion compared to last year's $1.869 billion. Now, our tax rate in the fourth quarter was 26.1%, higher than last year's fourth quarter rate of 24.9%. For fiscal 22, based on our current estimates, which of course can always change, we anticipate that our effective normalized total company tax rate to be similar to fiscal 21, somewhere in the 26 to 27% range. Unless, of course, there are changes to the U.S. corporate tax rates. We'll have to wait and see. A few other items of note: warehouse expansion. For fiscal 21 that just ended, we opened net openings of 20. We actually had 22 openings, including 2 relocations, but a total increase of 20 net units. This year, we're looking to open at least 25 net new units, including second warehouses in each of China and France and our first location in New Zealand. As well, we plan to relocate 5 locations. Regarding capital expenditures, our fourth quarter 2021 capital expenditure was approximately $1.09 billion. Our full-year CapEx spend was $3.59 billion. As I mentioned in the last quarter's call, this included a relatively recent $340 million purchase of a distribution facility on the West Coast to support our big and bulky delivery activities. For e-commerce sales in the fourth quarter, ex-FX, increased by 8.9% year over year. That's on top of last year's Q4 e-commerce sales increase of 91%. Stronger departments, jewelry. We actually sold a couple of rings in the $100,000 range. Home furnishings was strong, pharmacy was strong, and sporting goods was strong. A couple of other large departments like majors and electronics, while very good sales, we had really outsized sales a year ago in the fourth quarter during COVID. Update on Costco logistics. Logistics continues to drive big and bulky sales. For the quarter, Costco logistics sales within our delivery was up 130%, and in the quarter represented 24% of all sales on our U.S. e-commerce site. That 24% compares to 11% of e-commerce sales last year. Mind you, much of that relates to moving things from other third parties to our own internal logistics department. Currently, approximately 7,000 to 10,000 daily deliveries via Costco Logistics are occurring and continuing to grow. In terms of our e-com app, we have over 10 million downloads. It's continually improving with additional features coming soon. Digital payment using the Costco credit card. It's in pilot in several locations with full rollout by the middle of next month. The ability to view warehouse receipts online, also next month. More detail on online purchases as well. And by October end, an improved mobile site, improved look and feel, a new landing page, and expanded information both for .com use and for enhanced warehouse information. From a supply chain perspective, I want to go back to two things, supply chain and inflation. From a supply chain perspective, the factors pressuring supply chains and inflation include port delays, container shortages, COVID disruptions, shortages on various components, raw materials and ingredients, labor cost pressures, and trucks and driver shortages. Domestically, anecdotally rather, even on a domestic side, various major brands are requesting longer lead times. Some cases, difficulty in finding drivers and trucks on short notice. Lead times on ingredients and packaging have been extended in some cases. So planning is crucial, which I feel our people have done a great job with that over the last several months. Also, we're putting some limitations on key items like bath tissues, roll towels, Kirkland Signature water, high demand cleaning related SKUs related to the uptick in Delta-related demand. Furniture delays and some shortages have caused traditional rollout times to go from 8 to 12 weeks up to 16 to 18 weeks. In some ways, we think that's an advantage. We're selling out generally merchandise once it's received within 2 weeks on most items, and we've ordered more and earlier. Same thing with toys and seasonal. We're bringing in some of the items early. Chip shortages impacting many items, as I mentioned in the last call. Examples of impacted items: computers, tablets, video games, major appliances. Feeling is from the buyers is this will likely extend into 2022. Again, we're ordering as much as we can and getting it in earlier, and I think as evidenced by the most recent sales results, we're doing okay with this. Despite these issues, in terms of transportation costs, they're increasing. We're reading about it every day. Containers, trucks, and drivers all are impacting the timing of deliveries and higher freight costs. Despite all these issues, we continue to work to mitigate cost increases in a variety of different ways and hold down and or mitigate our price increases passed on to the members. We've also chartered 3 ocean vessels for the next year to transport containers between Asia and the U.S. and Canada, and we've leased several thousand containers for use on these ships. Every ship can carry 800 to 1,000 containers at a time, and we'll make approximately 10 deliveries during the course of the next year. Moving to inflation, again, there have been many. There have been and are a variety of inflationary pressures that we and others are seeing, and more of it. As I discussed on last quarter's call, inflationary factors abound: higher labor costs, higher freight costs, higher transportation demand, along with container shortages and port delays, increased demand in certain product categories, various shortages of everything from computer chips to oils and chemicals, higher commodities prices. It's a lot of fun right now. Some inflationary sound bites, if you will. Price increases on items shipped across the oceans, some suppliers, or us paying 2 to 6 times for containers and shipping. Price increases of pulp and paper goods, some items up 4 to 8%. Again, we're trying to mitigate those where we can, and we think we've done a decent job of mitigating some of it. Plastics, resin increases on things like trash bags, Ziploc SKUs, pet products, including resin-oriented pet products, plastic cups, plates, plastic wrap, many items up in the 5 to 11% range. Metals, again, aluminum foil, mid-single-digit cost increases, as well as cans for sodas and other beverages. I mentioned commodities earlier: oil, coffee, nuts. They remain generally, according to our buyers, at 5-year highs, and so on. Higher import prices on things from Europe, like cheeses, both a combination of freight and FX. 3 to 10% increases on certain but not all apparel items. And fresh foods, inflation is up in the mid to high single digits, with meat leading the way, up high single to low double digits due to feed, labor, and transportation costs. Now, I was asked back in March at our second quarter earnings call at what level we felt inflation was running overall on the sell price side. I stated that our best guess at the time was somewhere between 1 and 1.5%. I updated that 16 weeks ago on our May 26th third quarter call, and we upped it estimate to be in the 2.5 to 3.5% range. As of today, and talking with our senior merchants, we would estimate overall price inflation of the products we're selling to be in the 3.5 to 4.5% range. As I discussed earlier, this inflation was the driver of the $30 million Lifo charge that we took in the quarter. But all of this said, I feel very good with the job that our merchants, our traffic department, and our operators have all been doing and able to, in order to get the products that we need, pivot when and where necessary, and keep our warehouses full while keeping prices as low as we can for our members and continuing to show incredible value versus our competitors. I think this is reflected in our strong reported sales and profits that we've achieved despite challenges and our typical aggressive pricing. Finally, in terms of upcoming releases, we will announce our September sales results for the 5 weeks ending Sunday, October 3rd, on Wednesday, October 6th, after the market close. And with that, I will open it up for questions with Ann. Ann, thank you.
Thank you. As a reminder, to ask a question, you will need to press star, then the number 1 on your telephone. That's star 1 on your telephone. To withdraw your question, please press the pound key. We have our first question from the line of Simeon Gutman from Morgan Stanley. Your line is now open.
Hey, Richard. My first question is on next fiscal year. I know you don't give a lot in terms of guidance, but wanted to ask if you think, or how should we think about EBIT, whether it grows or not next year. And if you don't answer that, I was going to ask if comps grow in fiscal 22, should EBIT grow?
Well, on the first question, of course, I can't say. We don't provide guidance. But, we've always talked about being a top-line company, and that helps a lot of things. So depending on what level of sales, we'll have to wait and see. We do have the dollar increase that started in March that'll anniversary next February, so at the end of Q2 next year. But again, we've shown that even with what we view as holding the line as much as we can on pricing and being pretty aggressive there and taking that into account, we've shown that with strong sales we can certainly improve the bottom line as well. So fingers crossed.
So my follow-up, maybe two parts, and one of them is on sales, and then you mentioned the wage increase. So on the sales side, is there anything that you're looking at or approaching different? I know extreme value is one angle, but timing of mailers, inventory availability looking better. Is it ancillary that hasn't recovered? What can you do on the top line given how big of a lap? And then you mentioned the wage increases, and I know you'll lap those in March, but you've seen, I think Amazon and Walmart have moved up, and so I'm curious if you how do you think about, or should we expect another increase in terms of wages?
Sure. Well, first of all, as it relates to all the anecdotal comments I made about supply chain and inflation, I think overall we feel that we're doing a heck of a job in that stuff. And I think some of the advantage we have is that we certainly have the financial ability to bring in things early or to order early and to mitigate whatever delay may have occurred. We certainly have the space to keep some of this stuff, most particularly because of our Costco logistics acquisition a year ago, too, additional storage space, if you will. Not that we're having an issue with that, because it's turning pretty fast, and the fact that we're able to pivot, we're bringing in new items. We're bringing in items off season. For Christmas, not pre-COVID, it was toys and trim a home and electronics. Today, it's all those things plus things for the house, from barbecue grills to even summer items, but anything you can get your hands on. And again, I think we've done a very good job of adding suppliers where we can, and also making sure we're coming up with new items and being creative and innovative even on the food and sundry side. So I think from that standpoint, despite sometimes looking at each other, the merchants and the traffic people and everything, is saying, boy, this, when is this going to end? The fact is, I think we're doing a very good job of that. So from an inventory standpoint, I think for those of you who, several of you do go in and visit our locations on a random basis, they're full. They look good compared to some of the pictures we see from others sometimes. And so I feel from that standpoint, we have a good issue. With inflation, to the extent that there's permanent inflationary items like freight costs or even somewhat permanent for the next year, we can't hold on to all those. Some of that has to be passed on, and it is being passed on. We're pragmatic about it, but we recognize that since things have been so successful and our sales have been strong, we can hold the line on some of those things and do a little better job, or hopefully do a better job than some of our competitors have, and be even that more extreme in the value. So I think all those things so far, at least despite the challenges, have worked in our favor a little bit.
Okay. Thanks, Richard.
Thank you. Our next question comes from the line of Michael Lasser from UBS. Your line is now open.
Good evening. Thanks a lot for taking my question, Richard. In the past, what you've said is that Costco's profitability tends to draft off the profitability of the overall retail sector. In the last year and a half, the profitability of the overall retail sector has moved nicely higher. Also, Costco's profitability, its margins have moved nicely higher. Do you view this as sustainable?
Well, first of all, let me finish. Simeon had one other question on wages, and let me just respond to that. Look, we're known for always being want to have the best wage package and benefits package and take care of our employees package out there in big retail and big boxes and all forms of big retail. And even if we raised our starting wage to that $16 and $16.50 of late. Mind you, our average hourly wage is, I think, in the U.S. is slightly north of 24, with a very healthy employee benefit plan. We'll do whatever it takes to continue to that model, and who knows when and where, but we feel pretty good about where we are. And but as many of you on the call know, irrespective of what's going on with our company in terms of strong sales or weak sales, we're going to do what's right by our employees. And Michael, I'm sorry, now go back to your question.
Yeah, my question was, we've seen an improvement in profitability across retail that tends to influence the profitability or the profit margins of Costco. Do you view this improvement to your profit margin as sustainable from here?
Okay. Well, look, I think the anomaly over the last year and a half has been that when a lot of big boxes or big retailers were enjoying comps pre-COVID in the I'll call it the 2 to 4% range or the 2 to 5% range, and we were enjoying 5s, 6s, and 7s. Now we've been enjoying mid-teens or effectively low to mid-teens over and we've taken some market share from others. We think that some of that will stick, and we hope it will stick. And we feel pretty good right now about what we've done and what we've accomplished. To the extent that we can generate greater than industry average comps, I think, and that they don't have to be in the low to mid-teens. They could still be in the mid to high singles. That we should continue to improve. But again, I get back to the comment that has been reinforced internally from the beginning of time. We are a top-line company, and everything else will take care of itself.
Got it. My second question is on your gross margin. There's a lot of moving pieces, as there are a lot of moving pieces with everything that's happening with Costco right now. But specifically, you're giving back some of the core-on-core gross margin gains that you experienced from really strong fresh sales last year. But on the other hand, your ancillary businesses are doing really well. So is that dynamic where you're making up for the pressure on the fresh with strong ancillary, is that sustainable? And as part of that, the perception is that Costco tends to raise prices at a slower rate than others in the retail landscape, which tends to pressure its margins as inflation is heating up. What would be different this time to make that not happen? Thank you.
I think your first part of your question, I think, tells part of the tale, is there's so many moving parts. If you look at gasoline, which is 10+% of our sales, it's a huge business which can have huge variations of gross margin. Knock on wood, always profitable, but it's still quite a range of gross